In the intricate world of global finance, few assets command the historical and psychological significance of gold. Recently, this timeless safe haven has captured the spotlight. With its price embarking on a powerful surge, breaching critical resistance levels, and stoking fervent interest across the investment spectrum, we're witnessing a rally that has not only broken records, but has also ignited a fierce debate among market analysts. Is this a sustainable ascent, fueled by sound fundamentals, or are we on the precipice of a speculative bubble, inflated by euphoria and poised for a painful correction? Today, we will dissect the multifaceted forces propelling gold to these new heights. Heed the cautionary signals emerging from major financial institutions, and analyze the correlated movements in other key commodity markets to provide a comprehensive 360-degree perspective on this critical trend. Understanding this dynamic is not merely an academic exercise. It is essential for any serious investor seeking to navigate the increasingly turbulent waters of the global economy. The current strength in the gold market can be attributed to a confluence of powerful macroeconomic and geopolitical catalysts. Foremost among these is the shifting stance of the world's most influential central bank, the U.S. Federal Reserve. The explicit signaling of a pivot towards monetary easing with interest rate cuts on the horizon has fundamentally altered the investment landscape. In a lower interest rate environment, the opportunity cost of holding non-yielding assets like gold diminishes significantly. Traditional fixed-income instruments such as government bonds become less attractive as their yields fall, compelling investors to reallocate capital towards assets that can preserve wealth. Gold in this context reclaims its classic role as a primary store of value, a hedge against the potential debasement of fiat currencies that often accompanies periods of accommodative monetary policy. This policy shift by the Fed has acted as a powerful tailwind, providing the initial and most significant thrust for the recent price breakout. Compounding this monetary factor is a global backdrop of escalating geopolitical and economic instability. From persistent tensions in key regions to the specter of resurgent inflation looming over major economies, a pervasive sense of uncertainty has taken hold. In times of turmoil, institutional and individual investors alike gravitate towards assets perceived as unshakable stores of value. And gold's historical performance in this role is unparalleled. This flight to safety is not a new phenomenon, but its current intensity is noteworthy. The demand is not just for paper gold in the form of ETFs and futures contracts. There is a tangible increase in the demand for physical bullion. This reflects a deeper, more visceral anxiety about the stability of the financial system and the long-term purchasing power of currencies. This hoarding impulse, particularly strong among retail investors who are growing increasingly wary of traditional financial assets, adds a robust layer of physical demand that underpins the price surge, creating a solid floor even as speculative interest ebbs and flows. Furthermore, we must turn our attention to the economic policies of the world's second-largest economy, China. Recent pronouncements from Beijing have signaled a clear prioritization of economic growth, suggesting that further stimulus and supportive measures are forthcoming to invigorate a post-pandemic recovery that has shown signs of faltering. As a colossal consumer of commodities, any shift in China's economic trajectory sends ripples across global markets. The anticipation of renewed industrial and consumer demand from China has a direct and substantial impact on the pricing of a wide array of raw materials. While the direct link to gold is primarily through consumer demand for jewelry and investment bars, the indirect effect is just as potent. A stronger, stimulus-driven Chinese economy buoys overall market sentiment and often correlates with periods of rising commodity prices across the board, creating a positive feedback loop that helps lift gold in its wake. The market is interpreting these signals as a green light for commodities, and gold is riding this wave of optimism. However, as seasoned investors know, every powerful rally carries within it the seeds of its own reversal. And a growing chorus of warnings is now emerging from some of the world's most respected financial institutions. The Bank for International Settlements, often referred to as the central bank for central banks, has issued a stark admonition regarding the potential for asset bubbles. The BIS points to a trifecta of worrying signs in both the gold and U.S. equity markets. A palpable sense of retail investor euphoria valuations that are stretching far beyond historical norms and a crescendo of media hype that fuels speculative fervor. These are the classic hallmarks of a market driven more by emotion than by sober, fundamental analysis. When prices become detached from their underlying value and are instead propelled by the belief that they can only go higher, the risk of a sudden and severe collapse escalates dramatically. The BIS's warning should be taken as a serious red flag, a reminder that the laws of financial gravity have not been suspended. Beyond the macro risk of a bubble, experts are highlighting the more immediate threat of significant price volatility. A core principle of market dynamics is that rapid near-vertical price ascents are inherently unstable. Such parabolic moves are often followed by equally sharp and painful corrections. Investors who enter the market late, lured in by headlines of record highs, are the most vulnerable. Buying at the peak of a speculative frenzy exposes one to the considerable risk of substantial capital loss should the market sentiment abruptly shift. A technical correction of 10 to 15% is not only possible but probable after such a swift run-up. Therefore, a disciplined approach is paramount. Chasing momentum without a clear strategy is not investing. It is gambling. Prudent investors must be prepared for this volatility, setting stop losses and avoiding the use of excessive leverage that could amplify losses during a downturn. This heightened risk is exacerbated by a well-documented behavioral bias, the herd mentality. In financial markets, the psychological comfort of following the crowd can be a powerful and dangerous force. As gold prices soar and dominate financial news, a feedback loop is created where rising prices attract more buyers, which in turn pushes prices even higher. This phenomenon can inflate a bubble and, more critically, accelerate a crash when the herd suddenly turns and rushes for the exit. Investors who lack a deep understanding of the market's fundamental drivers and who have not conducted their own thorough due diligence are particularly susceptible to being swept up in this collective behavior. They are often the last to buy in and the first to panic sell, crystallizing losses. True investment success is built on independent thought and rigorous research, not on following the direction of the crowd. To gain a more holistic understanding of the current market environment, we must look beyond gold and examine the signals emanating from related commodity markets. The price of copper, often called Dr. Copper, for its purported ability to predict economic trends, has been surging in parallel, recently breaking past its all-time highs. This rally is not merely speculative. It is grounded in powerful fundamental drivers. China's new pro-growth economic policies are a major factor, given its status as the world's largest copper consumer. Simultaneously, the global push towards electrification and the green energy transition is creating a structural increase in demand for copper, which is essential for everything from electric vehicles to wind turbines and solar panels. This demand surge is colliding with a constrained global supply, with few new major mines coming online. The record-breaking prices in the copper market signal a broader inflationary pressure on industrial metals and suggest a genuine upswing in global industrial activity, a signal that lends some fundamental support to the bullish case for commodities in general. Silver, gold's more volatile sibling, has also been posting truly impressive gains. In fact, on a percentage basis, silver's price increase has more than doubled that of gold since the start of this rally. Several factors are fueling this outperformance. A weakening U.S. dollar, which makes dollar-denominated commodities cheaper for holders of other currencies, provides a general tailwind. Specific policy actions, such as tariffs on industrial goods, can also disrupt supply chains and influence prices. Most importantly, however, is silver's dual nature as both a precious and an industrial metal. While it benefits from the same safe haven demand as gold, it is also experiencing a massive surge in industrial consumption. Silver is a critical component in solar panels, 5G technology, and electric vehicles. With industrial demand projected to hit record levels and supply struggling to keep pace, a significant structural deficit is forming in the silver market. Silver's dramatic outperformance is a strong corroborating signal, indicating that the current rally in precious metals is not solely a monetary phenomenon, but is also supported by robust real-world demand. In conclusion, the current gold market presents a picture of remarkable complexity, a tapestry woven from threads of monetary policy, geopolitical risk, speculative fervor, and fundamental industrial demand. The surge in prices is underpinned by legitimate factors, including the Federal Reserve's dovish pivot and persistent global uncertainty. However, the speed and magnitude of the rally, coupled with explicit warnings from institutions like the BIS and the clear presence of herd behavior, demand a high degree of caution. The parallel bull markets in copper and silver provide further context, suggesting a broad-based commodity upswing, but also highlighting the unique drivers affecting each asset. For investors, this is a moment that calls not for impulsive action, but for careful deliberation. It is imperative to conduct thorough, independent research, to clearly define one's investment objectives, whether for short-term gains or long-term wealth preservation, and to honestly assess one's own tolerance for risk. Navigating this environment successfully will require a blend of analytical rigor, emotional discipline, and a deep appreciation for the powerful and often contradictory forces at play.